Good day, everyone. We are pleased to present our case study entitled AirAsia Berhad's Accounting in the Spotlight. AirAsia Berhad is one of Asia's leading low-cost airlines, established in Malaysia in 2001. Through its affordable business model and rapid regional expansion, the company successfully established operations in several countries, including Thailand, Indonesia, the Philippines, and India, through joint ventures and associate companies. As a result, AirAsia became one of the most recognized airline brands in the region. However, despite its remarkable growth, AirAsia came under intense public scrutiny in June 2015 following the publication of a report by GMT Research. The report questioned the company's accounting practices, particularly the way it accounted for its foreign associate companies. This controversy sparked debate among investors, regulators, and also accounting professionals regarding whether AirAsia's financial statements truly reflected its financial position and complied with the requirements of MFRS 10 and IFRS 10 on consolidated financial statements. This case is significant because it highlights the importance of transparency, accountability, and good corporate governance in financial reporting. It also demonstrates that accounting is not only about complying with standards, but also about ensuring that financial statements provide a true and fair view of a company's performance for investors and other stakeholders. In this presentation, our group will discuss the background of the case, analyze the major accounting and corporate governance issues, evaluate the external environment through a pastel analysis, and propose recommendations to improve financial reporting quality and governance practices. Without further ado, I would like to hand over the presentation to the next presenter who will explain the case overview and the pastel analysis.
The AirAsia case starts with a big public argument known as an accounting controversy. A research group called GMT Research wrote a report saying that AirAsia overstated its profit by making a transaction with associate company to look more successful. This situation brought the main issue out into the open, which focused on the consolidation of associates, complicated related party transaction, and the impairment of investment because their partner companies was losing money. In the end, this problem created major corporate governance and ethical concern for the airline. It made everyday investors worry about the true level of management transparency, the strength of audit community oversight, the fairness of auditor independence, and the protection of minority shareholders who own smaller amount of stock and suffer when the company has trouble. Moving on to pastel analysis. A pastel analysis is a strategic framework used by organizations to identify and evaluate microenvironmental external factors that impact their performance. So, firstly is political, which is different aviation regulation across country affect overseas operation. Secondly is economic, full price volatility, exchange rate fluctuation, and losses from foreign associate increase financial pressure. Next is social, investor and stakeholder expected transparency and accountability in financial reporting. Then in terms technological, which is rapid expansion and complex operation requires sophisticated financial reporting system. Legal compliance with MFRS or IFRS standards become crucial in determining whether associate should be consolidated. And the last one is environmental, which is sustainability requirement and environmental regulation increase operational costs.
Analysis Issue 1 Non-consolidation of foreign associate companies. According to MFRS 10, a company can only consolidate another entity if it has power over the investee, exposure to variable returns, and the ability to use that power to affect those returns. In the Asia case, these foreign airlines were treated as associates using the equity method instead of being consolidated as subsidiaries. This is because legal ownership restriction and aviation regulation in foreign countries prevented AirAsia from exercising full legal control over this airline. Next, these foreign airlines are not consolidated because their assets, liabilities, revenue, and expenses are not included in Asia consolidated financial statement. Instead, Asia only records its share of profit or loss from this associate and the carrying amount of its investment. As a result, the reported revenue, expenses, and total asset may appear smaller compared to full consolidation. Lastly, stakeholder implication. For investors, the financial statement may not fully reflect the overall economic position of all entities related to AirAsia. For shareholders, there is a risk that profits are overstated because only the share of profits is recognized without showing the associated full liabilities and operating costs. For auditors, their responsibility is to ensure that AirAsia complies with MFRS 10 and that the classification of these foreign airlines as associate is properly disclosed. In conclusion, although the consolidation follows accounting standard, stakeholders should carefully interpret the financial statement.
So based on the analysis just now, there are three strategic recommendations that AirAsia can consider. Firstly, AirAsia should enhance its financial disclosure by voluntarily providing the supplementary audited pro forma consolidated financial statements alongside their standard reporting. So this will allow the stakeholders to view the financial performance of the entire AirAsia network as a single economic entity and also reduce the perception of off-balance sheet activities. Secondly, AirAsia should establish the strict caps and monitoring on intercompany receivables by implementing the governance limits on the amount of credit extended to the foreign associates for working capital and also the aircraft leasing purposes. In addition, the structured repayment schedules should be enforced and supported through local equity fundraising or stock market listings by the associates. And finally, AirAsia should lobby for the regulatory reform and structural realignment by actively engaging with Asian aviation authorities to advocate for more flexible foreign ownership regulations while preparing for a unified regional operating structure if the future regulations permit. So these recommendations can generate several important strategic benefits for Asia. Firstly, the enhanced financial disclosure through the pro forma consolidation can help restore the investor confidence and also mitigate the market skepticism by directly addressing the GMT research allegations regarding the aggressive accounting practices and also the inflated parent company profits. And the additional disclosures would reduce the ambiguity and also provide the investors with a clearer understanding of the group's actual financial position. Secondly, implementing the caps on the intercompany receivables, it will help protect the AIS's balance sheet from toxic credit risk. So this ensures that loss-making associates such as those in Indonesia and the Philippines do not place excessive pressure on the parent company's cash flow or result in significant impairment losses. And finally, these recommendations can help bridge the gap between the substance and the form. While Asia continues to comply with MFRS 10 due to the absence of the legal control over its foreign associates, these proposed measures better reflect the economic reality of Asia, operating as the highly integrated regional airline network.
AirAsia record an increasing number of third-party transactions with its associate company. Although RPT are legal, they must also be properly disclosed because they may create conflict of interest. So investors question whether these transactions were conducted at arm's length and whether the board and audit committee are provide the sufficient oversight to ensure the transparency. So next we will see the economic reality and stakeholder impact. There was no direct evidence that AirAsia intentionally inflates its profits, but however, the accounting treatments of investment and related party transactions made the investor question whether the report profits accurately reflect to the company's actual performance. And another concern was whether the receivables from associate companies were genuinely recoverable. If these receivables cannot be collected, the asset report in the financial statement may be overstated and is giving the investor an overly positive view of the company's financial health. And lastly, according to the accounting principle, financial statements should reflect the economic reality rather than the legal form of transactions. And although AirAsia comply with the accounting standards, many analysts believe that the financial statement do not fully represent the company's actual economic conditions, which reduce the investor confidence.
So after looking at the governance issues and their impact on investors, we believe that there are 4 key recommendations that AirAsia should consider. Firstly, the company should strengthen their corporate governance by enhancing the role of the board and the audit committee because better oversight can improve accountability and also help to prevent similar issues from happening in the future. Next, AirAsia should improve their transparency of the financial reporting and ensure that important information is disclosed. This is important because investors rely on accurate information when making decisions. Thirdly, the company should focus on building stronger relationship with investors through more effective communication, where AirAsia can gradually rebuild investor confidence and also improve their market credibility by providing regular updates and maintaining transparency. Lastly, AirAsia should foster a stronger ethical culture and reinforce their internal control system because this will encourage integrity and accountability throughout their organization and also reduce the aggressive accounting practices. So overall, these strategies can help AirAsia to regain their investors' trust, improve transparency and accountability, and also ensure sustainable growth in the long run.
Moving on to our third major area of analysis, the roles of the audit committee and also our external auditor PwC. Firstly, regarding the audit committee, they were responsible for overseeing the financial reporting and ensuring that related party transactions were fair and reasonable. So while they met frequently, for example, 13 times in 2015, the big question is, were they effective enough? Critics argue that despite these meetings, the committee failed to adequately address the aggressive accounting practices that led to such extreme investor concern. Next, we must look at the PwC's role. PwC maintained a strict interpretation of MFRS 10, advising that AirAsia could not consolidate its associates because they lacked legal power, despite the economic reality in the group's intertwined business. However, in 2016, PwC did identify the impairment of this associate investment as a key audit matter, acknowledging the risk associated with their carrying amounts. Ultimately, we have to ask, did they perform their role properly? While they followed the technical standards, one could argue they missed the bigger picture regarding the economic reality of the company's business model. So, this highlights the crucial gap between strictly following the accounting rules and also providing a truly transparent view for the investors.
To conclude, the AirAsia Berhad case demonstrates that financial reporting extends beyond simply complying with accounting standards. It also requires companies to exercise professional judgment, maintain transparency, and uphold strong corporate governance in order to protect the interests of stakeholders. Throughout this presentation, we have discussed the key issues surrounding the non-consolidation of foreign associate companies, related party transactions, corporate governance concerns, and the importance of complying with MFRS 10. We also examined how these issues affected investors' confidence, financial transparency, and the company's overall reputation. Based on our analysis, we believe that AirAsia can strengthen stakeholder trust by enhancing financial disclosures, improving communication with investors, reinforcing corporate governance practices, and maintaining effective internal controls. These initiatives will not only improve transparency and accountability but also support the company's long term sustainability and growth. Overall, this case provides an important lesson that ethical financial reporting and effective governance are essential for maintaining public confidence and ensuring sustainable business success. Thank you very much for your attention. We hope this presentation has provided a better understanding of the accounting challenges faced by AirAsia Berhad and the importance of applying accounting standards responsibly. Thank you.